Long-term investors will experience a number of market downturns over the course of their lives. These downturns can be triggered by everything from natural disasters to political turmoil. So if you're investing for retirement or another long-term financial goal, you need to know how to weather a market downturn without being thrown off track. There are a variety of terms used to describe market downturns. For example, a drop in average stock prices of 5 to 10% is known as a pullback or dip. A drop of 10 to 20% is called a correction, and a drop of 20% or more is called a bear market. Another term you may be beginning to hear is recession. Simply put, a recession is a period of temporary economic decline, typically marked by a fall in gross domestic product, or GDP, for 2 consecutive quarters. While recession may seem like a scary word, and they're by no means pleasant, they most likely occur more often than you'd think. There have been 13 recessions since 1945, meaning that a recession occurs on average roughly every 6 years. It's also important to remember that the economy is not the stock market. The stock market is based on future expectations of the economy in the next 6 to 12 months, meaning that it's possible for stock prices to move up even during a recession. By contrast, economic recessions are based on past and current factors, and a recession may not be identified until months after it's begun. So, how should you invest during a downturn? The stock markets are notoriously difficult to predict, which is why market timing is generally a bad idea. For example, it might sound great to pull your money out at the top and redeploy it once the market hits the bottom, but it's almost impossible to know when these events will actually occur. Historically, the best thing to do during a downturn has been to sit tight and ride it out. That's because historically downturns in the market have always been followed by recoveries. And you can only benefit from the recovery if you hold on to your investments. We recognize that writing it out is easier said than done, and so market downturns can be a great time to speak with your financial advisor. An advisor can offer a third-party perspective, put things in historical context, and make certain that your actions are aligning with your goals. Market downturns are an unavoidable fact of long-term investing, and a sound financial plan takes that into account. If you've already got an investment plan that reflects your unique situation, then the best thing to do during a downturn, based on the historical performance of the stock market, is to remain committed to that plan. As always, if you ever have questions, or if you're concerned about the current volatility in the markets, give our team a call at 210-547-3450.